the momentum of growth in India is so strong, supported not just by domestic demand, but a gradual geopolitical shift that is making India an attractive manufacturing base for global corporations. An increasing number of companies are migrating their supply chains and manufacturing from China to India, particularly in electronics and pharmaceuticals. Anyhow, while all of this was happening, our firm UTI went public in October 2020. We are now a listed company on the National Stock Exchange of India, as well as the Bombay Stock Exchange, BSE. For the IPO, our anchor investors were Goldman Sachs, Nomura, Morgan Stanley, but our single biggest shareholder at 23% remains the American money manager, T. Rowe Price. With that longish preamble, I welcome you once again, and I would now like to invite my dear friend and colleague, Vetri Subramaniam, who is the head of equities for UTI, to share his perspective on 2020, as well as outlook for this year. Vetri, over to you.
Yeah, sure. Thanks for that introduction, Praveen. Yeah, it's been a pretty significant year, of course, and also a very painful year for many people. I think those of us who are privileged to be able to work remote, and those of us who work in the markets have been very lucky because the swift recovery in the market has meant that 2020 has actually turned out to be a pretty good year for everybody involved with the markets. But with that out of the way, what we thought today was we just share some of our key thoughts. Actually, Praveen, I'm going to request you, I think you're going to bring up the presentation. I just wanted to confirm that before I move ahead. Okay, so anyway, let's get going. I think, just in terms of a opening thought, I think one of the things that I would certainly consider for us to have been very lucky this particular year is the fact that the virus, after the initial surge of infections that we saw in the early part of the year through March, April, May, June, has actually sort of seen a very steady decline in the infection rates in India. And as a result of that, I think it's certainly aided the normalization of economic activity in India. So Praveen, if you just want to move down 2 slides, you'll get a chart of the COVID infection rates in India. So I'm not an epidemiologist, so I don't really have the ability to tell you why this has happened. Why is it that India has not really experienced a second wave of infections, so to speak? And as you can see over there, the infection rates and the death rate, and we can't but say that this has created grave tragedy for many people and many families. But as this data shows, after peaking somewhere in late August, early September, the COVID-19 trajectory in India has been steadily downwards. There were concerns in October, November, which, remember, in India is typically the festival season. There were concerns that this could lead to a second wave and a surge in infections. But that didn't really happen, and the curve has continued to trend significantly lower. I think what you see here on these slides is really the impact. Yeah, we can just move to slide 4. What you see in this slide is that as India moved beyond the trajectory of the initial lockdown and then started to open up economic activity in, I would say, sometime in early June 2020, activity levels started to pick up quite dramatically. And if you look at a host of economic indicators, we've actually got to a point where many of them are actually now in positive trajectory on a year-on-year basis. These include sales of personal vehicles, these include power generation, the sales of fertilizers and agricultural implements have moved into positive territory thanks to a good monsoon. And most importantly, from the government's point of view, goods and services tax collections as well have moved into positive trajectory on a year-on-year basis. So if we move to the next slide, the impact of this recovery in activity has essentially been, as you can see on slide number 4, if you look at that extreme right side, there was a point in time where the expectation was that FY21, which mind you in India means the financial year ended March 21, would actually land up with a decline in earnings for corporate India. But as activity levels have normalized, there was a significant positive surprise in the quarter ended September 20, when earnings actually went up by almost 20% year on year, as against an expectation of an earnings decline. And as a result of that, we now expect, based on the Bloomberg consensus, earnings to be more or less flat for FY21, but I would also suggest that there is potential for upgrades to these numbers even for March 21. And of course, the forecast is for a very strong earnings recovery to kick in sometime in March 22, with earnings expected to grow almost 35%. So the forecast really in that sense now reflect a significant rebound in activity. And you can see this on the next slide, slide number 5. You can see those last few lines on the right corner. As you can see, early on during the lockdown, the earnings estimates got cut. And then as we moved through September 20 and more indicators moved into positive territory, we actually started to see these earnings estimates move higher. And as I indicated earlier, I wouldn't be surprised if that March 21 earnings number gets revised upwards further as we go through the current earnings season. We've barely seen less than a tenth of the companies report earnings for the December 20 quarter, but we should have the full set of numbers by the middle of February, so another month, and I would estimate that most probably you will see some further upgrades. So this is as far as the earnings surprise and upgrades are concerned. If we move on to the next slide, that's slide number 6. Of course, these revisions have happened across emerging markets. And we've got a sample of some of the emerging markets over there. Where were the earnings estimates in June of 2020? And where are the earnings estimates as of last week? And there have been significant upward revisions in few economies, particularly Brazil and Taiwan. But India as well has seen continuous upward estimate revisions. And this is slightly different from what we see in some other emerging markets where actually estimates have been cut. And of course, Brazil has benefited from the recent surge in commodity prices, which is what has caused those earnings estimates to move higher. India, as you're aware, is not really that significantly led by commodity companies, and therefore to that extent, perhaps the increase is more muted. But really the context that I would put this in is simply the fact that there is been a much stronger revival in activity than anybody expected. At the worst point 6 months ago, the expectation was that March 21 GDP could be down as much as 10% for the full year. Those estimates have now come down to about 5 to 6%. And similarly, revisions for GDP for March 22 have moved higher. And in fact, now some of the estimates are calling for double-digit nominal growth in GDP. And I expect some of that to also filter into these earnings estimates in the coming weeks and months. So we can move on to the next slide, number 7. So where are we in the context of valuation? This is a slightly busy slide, but you can see the top 50 companies in India, which is the Nifty 50 at the top half of that slide. And that's obviously seen the price to book multiple move into what we would call expensive territory, well above one standard deviation. But if you look at the lower half of that slide, both in terms of mid caps and in terms of small caps, while valuations have moved up from the trough, they haven't actually moved into as expensive territory as the Nifty 50 itself has. So we would still say, yes, there are some concerning signals coming through from valuations, but when we sort of break it up into market segments, when we break it up into sectors, we are seeing a lot more nuances in the valuation, and there continue to be some opportunities in the marketplace. But yes, if you just look at the top 50 companies, certainly this is now, one standard deviation above average, and does create some level of valuation concern in the marketplace. Ajay will talk about this later, but of course it works to our advantage that UTI Equity Fund and the IDEF fund in Dublin has a significant exposure to mid caps and small caps, where the opportunity in terms of valuation still continues to look much more reasonable compared to the large caps. If we move on to the next slide, and I think this is again an interesting slide to look at, because as you are aware, India didn't really have much flexibility on the fiscal side to do much to support growth. So therefore, the total fiscal, sort of package in India is less than 2% of GDP, compared to many other developed economies where the packages are well over 10, and now perhaps in the US reaching 20% of GDP cumulatively. But on the monetary side, the RBI was quite aggressive, both in terms of cutting rates. It was also helped by the fact that there was a significant influx of capital flows into India, and therefore they've actually allowed M3 growth to stay very, very supportive. And this fits in with their own stated policy of using monetary policy as much as possible to accommodate growth and to support the economy. My sense is, other than the fact that they've actually cut rates and they've provided several sector-specific lending programs, what they've also done quite effectively is run through some targeted lending programs for which provide some kind of guarantee from the sovereign. And this has also helped a lot of the smaller companies in particular navigate what was a very difficult period when perhaps they couldn't really operate their businesses for almost 3 to 6 months. So I think this is remarkable simply because it's a sort of reflection of the thought process of the monetary policy setters, that they've been more than happy to allow M3 to grow and well in ahead of nominal GDP. And it would be my expectation over this current year as well, that they would be willing to support M3 growth at a level higher than nominal GDP, simply because they realize that this is the kind of environment where they have to be supportive, and that is pretty much the publicly articulated policy of the RBI and the Monetary Policy Committee. If we move on to the next slide, so India has not done much, as I said, on the fiscal side, but in the middle of the year, we did take a series of decisions, which really I would describe as more of supply side economics. These really relate to what we call the production-linked incentive scheme to sort of give manufacturing a new thrust in India. And they're doing this in two ways. They're providing incentives to companies to set up manufacturing in India, perhaps to take the place of products that were previously getting imported into the country. The second thing that they are trying to do with these production-linked incentive schemes is give an opportunity to companies to move perhaps their production facilities out of China into India by giving a very explicit subsidy. The PLI scheme is really a $30 billion subsidy scheme to companies that are able to access it, to set up manufacturing facilities in India, typically to replace products that are being imported, or, as has been very successful in the mobile phone and electronic space, to actually allow companies like Samsung, Apple to relocate some of their production facilities into India as part of their global supply chain. So this was one of the significant supply side measures taken by Government of India. The other two significant steps that they took, one was to simplify the labor code quite significantly, and the third one is essentially some of the reforms that they have carried out in terms of freeing the market for agricultural produce in India. So I would say they've used more of policy reform and supply side measures to raise potential growth rates in India rather than really a direct or significant fiscal stimulus, because their means were limited to begin with. And with what they've done on the fiscal side, it's largely been targeted at addressing the humanitarian issues faced by a large cross section of people employed in the unorganized and the informal sector. So with that out of the way, we can just move to the next slide. Just a quick, wrap of thoughts on slide number 10. Clearly, the rollout of the vaccine, including in India, we just kicked off, one of the largest campaigns to inoculate 300 million people over the next few months. That commenced on January 16th. So that's given, markets a lot of strength, not just in India, but across the world. Markets are looking beyond the loss of output that has occurred over the last 6 months as being something temporary, and that as we get back to normal levels of activity, we can sort of look to that as being what will really determine the true value of the companies that we own. The weak dollar, now at a 3-year low, has certainly driven capital into emerging markets, and that sort of helped strengthen balance sheets. Indian foreign exchange reserves are now well over $500 billion. The high frequency indicators in India, as I mentioned earlier, point to a significant recovery. We've not done much on the fiscal side, but as I said, the supply side measures that we've undertaken in the middle of last year should potentially raise India's overall growth rates in the years ahead. Consumer price inflation, significant cause for concern earlier this year. The MPC and the RBI chose to look through it, saying that this is more a reflection of supply side disruption. And I'm happy to report that the latest print for December was well within their comfort zone. And that also should enable the MPC and RBI to stay accommodative on the rate front. Beyond that, we already talked about valuations. There are some challenges, but there is a little bit more nuance once you look past the large cap sector of the market and look at mid caps, small caps, and even within sectors, we're seeing a lot of dispersion within individual sectors. Of course, these elevated valuations bring a level of risk along with them. And without doubt, markets are vulnerable to any sharp shifts in global liquidity. I think everybody worries about, any unexpected moves by the US Fed, like it happened in 2013 with the taper tantrum. So that is going to be at the background, and a concern for everybody. The other concern would be inflation expectations because of this sharp rise that we are seeing in prices across the board. Touchwood, as of now in India, we are well within the comfort zone, but this is something that we'll have to continue to watch, simply because if inflation starts to move up significantly again, then RBI will have to rethink its accommodative approach. So that's sort of where we stand as far as the markets are concerned. I always make the point that we don't have a specific forecast of what the market will do. That's not how we think about investing. Our job is really to pick the companies and create the portfolios that we think can add alpha over and above what the benchmark does. And so it's really not key to our investment process to really try and think about what percentage gain the markets will deliver in a given year. And certainly I couldn't have forecast the outcome over the last 12 months, given the events at the beginning of the year. So, markets will surprise, but it's our business to stay wedded to investment process, to discipline. And I think that's what has guided a very strong set of outcomes for UTI. Most of you are familiar with the IDEF, and you've seen the strong performance there. But I'm happy to report, as head of equity at UTI Mutual Fund, that we've had a very strong set of outcomes across the board for many of our strategies, and it goes back to the discipline that we have in executing. I'm particularly happy to note that our portfolio turnover ratios across a range of strategies remained fairly muted through the year. In fact, if I look at our 12-month trailing portfolio turnover ratio as of December 20, for most of our funds, it was even lower than the portfolio turnover ratio of December 2019. And I think it just goes back to the fact that there's no such thing as reacting to the market. Our investment process guides us, and it just helps us sort of position in the kind of companies that are able to manage these kinds of challenging circumstances much better. So we are moving on to the issue of companies, and there's a good point for me to pause, hand over to Ajay. Most of you know Ajay very well. He's been the fund manager for our offshore funds for nearly a decade now. Career in UTI well over 20 years. And of course, the IDEF itself has now completed more than 5 years with him being at the forefront as fund manager. So I'll hand it over to him now, and he'll run you through what the India Dynamic Equity Fund is currently doing and how it's been positioned through the year. Over to you, Ajay.
Thanks, Vetri. And good afternoon and good evening to all of you on this call. Let me start by wishing all of you a happy and prosperous 2021. Picking up from where Vetri left, let's just see some very familiar slides that we've been discussing over the years. I'm sure you would be reminded of our conversations around this slide. The purpose of putting it here is that this still remains our guiding pillar. Quality and growth are the two pillars of our philosophy, and nothing changes insofar as these two key pillars are concerned. And I've been saying and discussing, quality for us protects downside. It's the surest measure of figuring out the economic value creation in a business. And the stronger the quality, which we typically determine by return on capital employed and cash flow generation, the stronger is the ability to protect downside whenever volatile times fall on us. Growth basically helps us in compounding this economic value creation. And it is important for us because whenever economies start to recover and businesses start to grow, it is this particular vector that helps us to compound the economic value and therefore allow our fund to compound wealth. These two pillars have been serving us well over the last 10 years, and nothing changes in our view about constructing our portfolio, keeping these two pillars in mind. 2020, if anything, only reinforced our belief very strongly that this is how we should proceed in the coming times as well. Yeah, next. The next one, please. So let me start by discussing how did the portfolio behave in terms of the sectoral changes between 2019, December 2019 that is, and December 2020. If you have a look at this slide, you would be able to realize optically that there hasn't been much change in terms of our sectoral outlook. And I've said this before, the portfolio turnover ratio for the India Dynamic Equity Fund remains very low. 2020 may have seen slightly higher portfolio turnover, predominantly because of the fact that we did see outflows happening from the fund in the early part of the year and towards the later part of the year, typically October, November, and December. These 3 months, we saw huge inflows. And that itself led to some bit of, I would say, turnover in the portfolio. Other than that, we haven't been consciously moving our money from one sector to the other, and we haven't been taking calls around what will do well in this pandemic and what will not do so well. What you see here is more of a mark-to-market reflection rather than actively churning in or churning out of sectors. Next. These are the top 15 holdings as of 2019, 31st December 2019 and 31st December 2020. Again, as you can see here, basically not much difference. Our key holdings have been pretty similar across these two time frames. Like I mentioned, we haven't moved a whole lot. Of course, we have introduced a few new stocks in 2020. I'll talk about those. Just like we have exited a few stocks, but that's par for the course. I think every year I've been saying that there would be 3 to 4 new ideas that will enter the portfolio. Of course, there'll be some years with 5 or 6 new ideas coming in, and there'll be some years where possibly we don't find anything exciting, and therefore there's no new entry into the portfolio. And of course, there are a few exits. These exits typically are the ones where we feel that our hypothesis doesn't hold true anymore. Exits are usually, in fact, I should say, exits are never made on account of valuations going overboard. That only calls for paring down the position size. Exits are made only if we feel that our hypothesis for the business doesn't hold anymore. So again, just to reiterate, as you can see in the top 15 holdings, not much change. There will obviously be some mark-to-market change that you would witness in our sectoral exposure as well as stock exposures, but that's something which keeps changing, and we don't look at buying in or buying out every week or every month just because there's some mark-to-market change here and there, unless until the change is really significant. And I think I should really speak about what happened in the months of March and April. Financial services and within discretionary auto were two sectors that were badly punished, and consumer, pharmaceutical, and healthcare services were sectors which are actually rewarded for obvious reasons. It was only during this time that we realized that some of our key financials exposure have started to trade at levels which possibly one can see only once in, if not a decade, once in every 4 or 5 years, significantly lower than their average valuations for the previous decade. And that was a time when we took some money out of consumer pharma, not because we thought that the rally there was overdone. We never have any view about how stock prices will behave over the next few quarters, but we basically felt that we really are getting some businesses in the financials and the auto space very cheap. The only way to take advantage of that was to take money off from certain businesses or certain sectors which had actually benefited on account of the pandemic and where prices had actually moved up. These are typically the only times when you would see us act in terms of buying something which we like and which has fallen in our portfolio. A 5, 10, 15% kind of movement one way or the other doesn't excite us too much. Yeah. Okay, so here we have the key entrants and the key exits from the portfolio. I do remember in the earlier call, we had categorically mentioned that we've had a very, very sharp look at our portfolio, and we've come back with a conclusion that 97 to 98% of our portfolio is not going to get impacted because of the pandemic, by which we meant that there's not going to be any structural impact to the businesses that we hold in the portfolio. But yes, there seem to be 3 or 4 businesses totally adding up to maybe 2.5% in terms of weightage, which may see some structural change. The 4 businesses that you see on the right are the ones where we decided to exit because of maybe the structural change which got accelerated on account of the pandemic. On the left-hand side are businesses where some of them we had been tracking for a long time, but maybe we were not too convinced about the valuation, or maybe we were not too certain about the hypothesis itself. We weren't able to get our arms around the business. Therefore, we took some more time to actually get a deeper understanding. And sometime during 2020, either on account of valuations falling significantly or on account of our conviction on these businesses growing, we were able to get them into our portfolio. Let me take the example. Let me just call out a few of them and also illustrate our thought process and how we think during portfolio construction and how we think in terms of getting new ideas into the portfolio. India Mart, a business which IPO'd almost 2 years back. We've said this many times that while it would not be correct to say that we don't participate in IPOs, we do participate in IPOs, but we are slightly circumspect whenever a new business comes to the market, because we've always realized that there is a bit of information asymmetry whenever a new company hits the market. We don't understand the business as well as the management does or the existing investors does. And typically we feel comfortable owning something when we realize that we understand the business as well as one could. So that's the reason why we don't participate so aggressively in IPOs. India Mart was one such business, which is India's largest B2B marketplace, which basically has the typical business suppliers on one side and the business customers on the other side. It is India's largest B2B marketplace with about 70% market share. Like I said, IPO 2 years back. Balance sheet, cash flows, financials are all typically the ones that we like. So the company checked the boxes on the quality parameter. The company checked the boxes on the growth side, but we still wanted to get a little bit more certain and sure-footed about the outcomes of this business over the next 3 to 5 years. And as soon as we picked up, our confidence, we started building exposure. We were only lucky that we started building exposure just around the time when the pandemic broke out. And as a result, we could actually do some accelerated buying in the same. But like we've been saying before, new ideas typically would still be 0.5, 0.7 in terms of their 0.7% percentage points in terms of their exposure in the portfolio. And it's only after a few quarters, sometimes even a couple of years, that they will grow into more meaningful positions. But like I mentioned, we are plainly lucky. We got this very cheap, and post-September, I would say July and August, by which time we had already created a 70 basis position in this business, the stock basically just saw a meteoric rise. It actually tripled from those levels, and that's the reason why you see this position at 1.8% approximately. Relaxo Footwear, another interesting story. I would say that this is something which we missed out in this fund. And in the last 2 years, we were only waiting for the right opportunity for valuations to slightly come down. This is a business which basically holds the largest market share in open footwear. Some of you may be familiar with open footwear. It's very, very common in South Asia, where the upper part of the shoe is actually kept open, and it's not closed like the typical formal or sportswear that we wear. Or the sports shoe that we put on, and these kind of open footwears are very, very common in India. I would say typically common in a tropical country, and they're also in terms of price point a little lower than closed footwear. And Relaxo is basically a champion in this. Started their business in the 70s, has now become synonymous with open footwear. Some of their brands have become generic names actually. And the I would say icing on the cake is that apart from being a very strong brand, it still has a very long growth runway, because footwear market in India is still about 60 to 65% unorganized. There are a lot of these local brands which are still very common in India, and they hold majority of the market. Whereas players like Relaxo, all put together, collectively have only about 30% or thereabout of market share. So this is an industry which will continue to grow. Relaxo is a very established brand, and therefore, like any typical consumer brand, has high return on capital, strong cash flows, uses its internal cash flows for future growth. So, and the last one, okay, let me also quickly talk about Aavas Financiers here. Now, you would have heard me say this pretty often, that we are underpenetrated across different lines of financial services. Even the most basic product in any economy, which is mortgages, is a hugely underpenetrated product in India. Our mortgage penetration is about 10% of our nominal GDP. The similar number for emerging markets is about 30-35%, and in developed markets, this number is close to almost 100%. What's also important to note is that this present government under Narendra Modi, our Prime Minister, has been pushing for a lot of low-cost housing, has been pushing for the fact that people ought to be having their own homes, and has provided a lot of incentive especially towards low-cost housing. Aavas Financiers is one of those housing finance companies which specializes into low-cost housing in India. And it started with one particular province of India, which is towards the west of our country, called Rajasthan. And from there has been moving into adjoining provinces and states. And even today has covered no more than, I would say, 1/4 of the states or the population in India. Uh, Overall, like I mentioned, on a more broad basis, uh, the housing theme remains a high growth theme. We would continue to witness strong growth, and like it happens in any crisis, in this crisis, which basically it's not just the pandemic alone, but many of you would recollect that India has gone through a bit of a financial stress in the last 3 or 4 years because of a variety of reasons. And many companies which had mushroomed in the last 7 8 years have and could not manage their affairs well, have been severely damaged. Either they faced mortality or morbidity, because of which the competitive landscape in housing finance is looking much better today compared to what it was 3 or 5 years back. And that's another reason for being positive on Avas. Avas exactly fits into this narrative that I gave for India Mart. This company IPO 2 years back. We liked the management. We liked the story. We waited. We unfortunately didn't buy during the IPO. The stock went up very sharply. But 2020 gave us an opportunity to come in at a much lower level. But more importantly, those intervening 12 months gave us a lot of insights into Avas and also provided a lot of insights into how the management thinks. Uh, I'll just stop here. I think it's about time that we open up for Q&A and take your questions. So thank you very much for your patient listening. And Virina, we can start taking questions now.
Hi, I think I'll guide through the Q&A process. We've received one question on the chat here, which says, Vetri, it's directed to you. The COVID cases have shown a steady decrease since October, but how has the pace of testing changed?
So good question. There was a very conscious increase in the level of testing, particularly from January, as a result of which we saw the testing numbers go up, and simultaneously we also saw a drop in the positivity rate. So, in places like Mumbai, where at one point the positivity rate was, almost 20%, suggesting that we were doing a very low level of testing, that is no longer the case. And I think it's dropped to under about 6% now. So I would say the testing is now very, very reasonable. Could it be more? Perhaps, yes. But, 2-3 other things that I would point to. One is simply the fact that, we no longer have any reports, either first-hand or based on government data, to suggest that there's, either a shortage of hospital beds. In fact, some of the emergency COVID care centers, including one that's, just across the road from where UTI's offices in Mumbai are actually now running empty, and they're actually in the process of shutting it down. So there is enough anecdotal evidence to suggest that, for whatever set of reasons, the spread of the infections and the number of infections has come down, and the testing rate certainly, which was low in May, June, picked up quite aggressively by September, October. And in fact, just as a sort of second point, you look at a city like Delhi, and Delhi actually experienced a second surge in and around the month of October, which tallies with one of the festivals, which is quite important over there. But, a lot of the measures that they took at that point of time in Delhi has actually caused those numbers to then come down very, very sharply over the last 2 months. So I think, the data is what it is, but it certainly gives a lot of comfort to us and to the policymakers.
Thanks, Vetri. Vetri, if you could speak a bit louder. We have another question, and this is about the vaccination program. Do you know what vaccines have been approved or are being used?
So there are 2 vaccines which have been approved by the government of India. The first is the Oxford vaccine, because they have a partner in India called the Serum Institute, which is actually the biggest manufacturer of vaccines in the entire world. and they're talking about putting out 2 billion doses on their own. So that's one which has been approved. The second one which has been approved is by a local company called Bharat Biotech, based out of Hyderabad. This one is a little bit controversial because actually the final set of tests are not yet out in public, sort of realm in terms of the data. But the government has approved that vaccine as well for public use. So the Covaxin, which is developed by that local company, is also being used for this immunization campaign. To be fair, the company has a good track record. They were one of the first to develop a vaccine for rotavirus a few years ago. So they do have a track record in this. And very quickly, Praveen, you've also got another Indian pharmaceutical company, Cadila, which is in Ajay's portfolio. They're working on a vaccine as well, which is entering stage 3. We just had a conversation with the CEO last week, and he was quite excited about the progress they're making. And finally, another pharmaceutical company in India, Dr. Reddy's, is actually taking the Russian Sputnik virus through the final phase 3 trials. So, we do expect that there will be something else cleared in the next few weeks as well.
Great. Thanks, Vetri. Ajay, there's a question for you. Are there any sectoral bets that you see in the coming months, or are you going to stick with secular bets?
Yeah. So I think what's important to understand, or in fact, I should reiterate this, is that we are bottom up. So we don't take top-down views in terms of which sector will do well, are there sectors which will benefit out of the ongoing pandemic and so on. We remain bottom up in our focus. We look at introducing businesses which over the next 3 to 5 years will do well, fully knowing that we just don't know what the environment would be over the next 3 to 5 years. From that perspective, I can just reiterate that it will be secular growth businesses and no sectoral bets. And that's what we try to demonstrate by way of those slides. Our sectoral bets haven't moved much between 2019 and 2020.
Thanks, Ajay. Vetri, there's a question for you on a likelihood of the Fed starting to hike rates if inflation goes out of control in the US, and then what happens to the stimulus money and its resultant impact on emerging markets?
Well, I mean, that is certainly one worry we'll have to keep at the back of our mind because, let's face it, there's been a wall of liquidity which has driven markets around the world. India is not an exception to, record levels or to certainly multi-year highs. So any unexpected trend reversal there would be a cause for concern. But very interestingly, Praveen, just yesterday, we were on a call with former Fed chairman Ben Bernanke, and he actually spent quite a few moments explaining the Fed new modified approach towards inflation targeting, whereby they are open to the idea of an overshoot on the upside. And remember, this was a policy that was actually approved eventually by during Janet Yellen's time at the Fed. So in that sense, actually, one of the strong points he made yesterday was that a repeat of 2013 would look unlikely, simply because the Fed's own thought process has now changed towards allowing an upside overshoot to compensate for the period of time where inflation has been below target. So let's see, it's certainly something we need to be aware of as a risk, but I think, it's not something that we are particularly losing sleep over at this point. And India is well protected today with, $500 billion plus of foreign exchange reserves.
Thanks, Vetri. There's a question on how does UTI integrate ESG in the investment framework? Maybe I'll take this one. So UTI has always seen for itself a role in the Indian landscape, pretty much at the forefront of leading the change with our investee companies, the impact that we have with our pedigree and voice in the Indian corporate environment. And the concrete steps that we have taken, first of all, we have created an ESG committee. This is a very powerful committee within the firm, which will chart and design our ESG journey. UTI International was a signatory to UNPRI 5 years ago, and UTI AMC signed up in 2020 as well. This committee has been charged with the job of designing the ESG policy for the firm, and this will go live in the next couple of months. And there are some parts of the firm which are, let's say, a few steps ahead, which is the private capital business of UTI, which has not only created its ESG policy, but rolled out the first product which fully integrates ESG in its investment process. And it's a private credit fund which demonstrates measurable ESG improvement in the investing companies year on year. So we take ESG very seriously, and we are leading the change in India. There's a question on Ajay, probably for you. What is your outlook on buy and hold of large cap stocks, considering the positive signs the market has been showing of late?
Sorry, what was the second part of the question?
Are you still in favor of buy and hold large cap?
Okay. See, the answer to this one again is the fact that, we are bottom up. So for us, it doesn't matter whether the best idea is large, mid, small. It doesn't matter whether large caps have gone up or mid caps have gone up. So long as the prospects of the business remain as strong as they were when we first introduced the business into our portfolio, we will continue holding it. Now, there's nothing in finance literature, investing literature, or in our own experience which suggests that if small becomes mid or mid becomes large, then growth stops. In fact, I have seen actually, many businesses over the last couple of decades, when they attain a particular critical size, they just get into a sweet spot, and then growth is effortless over the next decade or so. So while remembering all of these experiences that we have had in different businesses across different industries, we only measure the ability of the business to continue doing those two things that we have written for ourselves. Ability of businesses to generate economic value, by which I mean return on capital as high as possible and not deteriorating as a trend. That's more important. And secondly, the ability of the business to basically continue growing and not seeing a secular decline in growth rate. So long as these things can carry on, it doesn't matter whether large caps are doing well or mid caps are doing well. Yeah.
Thanks, Ajay. Do we have a view on FX, USD INR, short term, long term?
So maybe Praveen, I can just take that
question.
Yeah. No, I mean, I won't really claim that we have a very strong view on what the currency is going to do. I think the only two things to which I would point, one is the Indian Monetary Policy Committee and the RBI are still reiterating their commitment to the inflation targeting regime of 4% plus or minus 2%, though that is up for review. So we're still waiting to hear any changes, if at all. But I think they've reiterated their commitment. And when you put this up against the US, which is now talking about 2% inflation and potentially even an overshoot of 2% being acceptable, it would suggest that the inflation gap between the two countries is going to be much smaller than what it was in the past, which should be good for foreign investors in terms of what the rupee is likely to do. And secondly, I think from RBI's point of view, I think they are conscious of the fact that there's been significant capital inflows. They are worried that too much appreciation could pose a risk to domestic companies and manufacturing and exports. So they have been accumulating reserves quite aggressively as the money has come in. And in fact, I think the US committee, sort of indicated it might look at India as being a currency manipulator. And the RBI governor was on record this Friday saying that even at the risk of that, we will continue to intervene because we think we need buffers. Our past experience of 2013 or even going back prior to that, suggests that having a large currency buffer is very, very important when those capital shocks take place. So, I would expect them to continue to intervene dramatically, build the reserves and prepare for that rainy day, if at all, when capital starts to flow out again.
Thanks, Vetri. Ajay, there's a question for you from Austria. Why should we invest into your funds as against the index? Yeah. Or if you want, I can take that, actually.
Yeah, go ahead.
Yeah, let me, one sec, let me share my screen. I have something. Is this visible?
Yeah.
Yes, it is.
Okay.
Now it's
So,
gone, Praveen.
okay. Do we
Yeah,
see
it's
it now?
visible again.
Okay.
Yes.
So there's three lines here. There's a blue line, a green line, and an orange line. And this is 10-year data. The blue and green lines are MSCI India and MSCI emerging markets. And then the orange line is the strategy, which is, this is the Shinsei fund, which is Ajay's strategy reflected for the last 5 years in IDEF. And as you can see, in dollar terms, the emerging market MSCI and India MSCI are pretty much intertwined at the bottom, very consistent performance in sync with each other, while our equity performance is clearly on a 10-year basis. If you see in this table on top, EM and MSCI India are about in their 40s, while our fund has delivered a performance in dollar terms of 144%. So 100% more in 10 years, and so on and so forth in even 3 and 5 years. Now, what happens is when one analyzes asset classes and countries, you typically do it on the basis of the index. And if you were to look at only the MSCI India, you'd completely miss out on the opportunity for excellent stock picking. And as Ajay has mentioned, India being an inefficient emerging market, it is ripe for picking good businesses, quality businesses that compound shareholders' wealth. In mature markets like the US or even US or Europe, I would say you are better off with getting market beta because performance of various fund managers are very narrowly bunched together around the mean. In India, the dispersion of managers is quite high, and a local manager with the kind of pedigree we have, on the ground presence, the ability to travel within the country and form views by meeting not just the investee companies, but visiting their businesses, understanding their vendors, their suppliers, and building this 360-degree intelligence around the businesses we invest in. I think that's what gives us an edge over, obviously, the index and as well as our peer group. We have a question on could you discuss the government reforms that have been implemented this year and whether there is likely to be a tangible impact on the companies in the portfolio?
Sure, maybe I can just describe the reforms and then Ajay can kick in after that. So as I said, I think one of, most of what they've done typically falls in the domain of what you'd call supply side measures. One is to target the fact that manufacturing in India as a percentage of GDP still remains very, very low. The target has been to take it up to 25% for the longest time, but we've been at closer to 15%. So this is really a very aggressive scheme by government of India. They're effectively spending $30 billion on this in terms of a subsidy. And this is essentially targeted at about 7 sectors where they are making this incentive available to companies, which could be anywhere between 4% to 6% of the revenues that these companies generate by producing products which either are replacing products that were earlier imported into the country, or in the case of certain other products, essentially these manufacturers would then be integrating into a global supply chain and exporting these products out to other countries. So it's a pretty significant spend that they are doing. And remember, this spend of 30 billion is over a 5-year period in these sectors, 6 or 7 sectors as I indicated. And all new manufacturing enterprises in India are in any case now entitled to a tax rate of just 15%. So, I think the economics of this for new investors and for entrepreneurs to make those investments, it's a very, very attractive deal. And I do think the government is likely to have significant success with this. The other interesting thing is that the way the scheme works, it's actually geared at champions rather than being widely available so that any company with a small sort of scale can also jump into the fray and get the subsidy. So it's sort of targeted at developing champions at scale rather than being widely available to everybody. So that's one big step that they've taken. As I said, depending on the estimate you see, people believe it could add anywhere between 1.5% to 1.7% of GDP over the next 5 years. The second one is freeing up of agricultural markets. Because previously, trade in agricultural products could only take place in government designated marketplaces. So therefore, bilateral contracts were effectively illegal. The large retail sector in India, the organized retail sector, couldn't really directly do transactions with the farmers. So they've changed a lot of the laws relating to this, which would free up trade in agricultural produce. And this is politically contentious, but I do believe it's a move in the right direction and will sort of create greater competitiveness within the agricultural sector. The third is labor reforms, where it's not really so much reform, it's really just simplification, because I think one of the challenges companies face is that they said the labor code is sitting in 400 different places. So what they've done is they've now simplified it down to 4 codes, and they've given the flexibility to the states to go ahead and provide certain exemptions if required. So we've got the example of 2 or 3 states where they've actually given a sort of a holiday from applicable labor laws for up to about 2 to 3 years to sort of boost local manufacturing. But for every other company, just the simplification of these codes, sort of makes their life easier in terms of dealing with the bureaucracy of labor law. Ajay, you want to comment on any benefits, if at all?
So yes, we are studying, the impact of the PLI scheme in particular. The other two, in fact, particularly the last one, would have an impact across sectors, across businesses. But on the PLI scheme, we are just trying to see whether any of our businesses, particularly in the pharmaceutical / healthcare space or in the chemical space, would be benefited. So there is a possibility also of some businesses in the auto ancillary space getting benefited, and the scheme itself can be rolled on to cover a few more sectors. As of now, nothing which has impacted any business in the portfolio already, but yeah, we are still studying the impact.
Okay, we have just crossed our 1 hour mark. There's still a few more questions coming through, but I will request all the participants to contact your relationship person in UTI, and we will definitely revert back to you. And if required, we can have other set of calls with us. So with that, I'd like to thank Ajay and Vetri for joining us today, as well as all the participants from across the world who have taken time off to join us. Thank you very much for your support to UTI, and we look forward to being continuously in touch with you. Thank you.
Thanks, Praveen, and thanks everybody for your time today. Thank you.
Thank you. Thanks, everyone. Have a nice day.